Assalamu alaikum and hello everyone. My name is Noor Zahra Irdina binti Zalizi Adlan, and I will be giving the introduction for our presentation. So before we continue, what exactly is accounting, you may ask? So accounting is considered as the language of business. It helps to record, summarize, and interpret financial statements so that people in a company can help see their performance better and understand on how to make better decisions. So why is accounting considered important? Accounting is considered as important as it is the foundation. So these 10 basic concepts are what hold a company together. And without accounting, it is very hard for a company to have a reliable, concrete, and stable financial reports or financial statements. So now let us dive deeper into the 10 basic accounting concepts.
Assalamualaikum. My name is Sofia binti Shamsul. So today I want to explain about the separate entity concept. So this concept means that the business and the owner are treated as two different persons. Even if the owner is the only one running the business, all the business transaction must be recorded separately from the owner's personal activities. So for example, if the owner uses company money to pay for personal bills, that should not be recorded as a business expense. Instead, it should be recorded as drawings. This concept helps to make sure that the business financial statement truly represent the business's performance, it's not the owner personal spending.
Now let us talk about the going concern concept. So this concept assumes that a business will continue operating in the future without any intention to close down. So this time period usually takes around 12 months. Due to this, a business will continue to prepare financial statements, record transactions, and maintain their accounts without any reason to close down their accounts. So for example, a bakery lists down their long-term equipment such as mixer, ovens as long-term assets. So because they believed that their business will not shut down in the future.
Assalamualaikum and hello madam. My name is Nur Anisa. In this video, I'll be talking about the accounting concept. So the third accounting concept is about money measurement. Money measurement concept in accounting means that only those transactions or events which can be measured in terms of money, like Ringgit Malaysia, or recorded in the financial statements. The example that I can give related to business or real life is like a company record the cost of buying a new delivery or asset for like about 80,000 ringgit, but they do not record a loyalty of employees because this cannot be measured in money.
Assalamualaikum to my respective lecturer. My name is Nur Sofia binti Muhammad Azaman. ID matric 012025070862. So today I'm going to explain about the fourth point of accounting principles, which is objectivity. So objectivity is all financial information based on trusted and verifiable proof. For example, assets should be recorded using official documents such as invoices, receipts, bank statements, also contracts. So this is to ensure financial statements are reliable, fair, and also trustworthy for external users like investors, banks, and also regulators.
The fifth accounting concept is the accrual concept. This means that income and expenses are recorded when they happen, not when the money is actually received or paid. For example, I own a company that delivers goods to a customer in December, but the customer only paid in January. So, I must record the income in December because that's when it was earned.
So now I'm going to explain the materiality concept in accounting. The materiality concept means that accountants should focus only on information that is important or significant enough to influence the decision of people who use the financial statement. In other words, if something is small or unimportant, it doesn't need to be recorded in a great detail. So this concept helps accountants save time and keep financial statement clear and easy to understand without unnecessary information that doesn't really affect the business performance. So for example, if a company buys a calculator worth 20 ringgit, it can be recorded straight as an expenses. Instead of listing it as an asset, the amount is too small to affect the company's overall financial position, so it's not considered material. However, what is material can depend on the size and importance of the item and also the context of the business. A small amount for a large company might be material for a smaller business. That's all from me.
For the seventh point of accounting principles, which is consistency. So what is consistency? Consistency is the same accounting methods that must be used for a business from one period to another. For example, a company simply switching methods without any reason, such as straight line depreciation method, should continue being used every year without changes. However, if the method changes, the company must provide clear explanation in the notes to the account. So what are the objective of this consistency? It is to make financial statements comparable over time and to allow meaningful trend analysis.
The eighth accounting concept is comparability concept. This means financial information should be prepared in a way that allows user to compare results over time or between different companies. For example, a company must use the same accounting method, like same depreciation method each year, so investor can compare this year's profit with last year's.
Finally, let's look at the prudence concept, which is also known as the conservatism concept. This principle tells accountants to be careful and realistic when recording financial information. They should not overstate income or assets and should record possible losses or expenses as soon as they are known. For instance, if a business expects that some customer might not pay their debts, an allowance for doubtful debts should be recorded immediately. However, expected profit should only be recorded when they are actually earned. This ensures that financial statements are not overly optimistic and remain trustworthy. Thank you.
Now, let us move on to the historical cost concept. So now this concept talks about how an asset should be listed at its original purchase cost instead of the price that was listed at market value. So if, let's say, the market values were to fluctuate, then the asset does not follow the fluctuation. It will not go down as well. So this ensures consistency and reliability in financial statements. For example, a company lists the price of its building the same price as when they first bought it and not at the current price it is now.
To conclude, all these accounting principles to ensure accounting information is relevant, accurate, and also trustworthy by enabling stakeholders such as management, investors, creditors, and regulator, which will make sound economic and also financial decisions. That's all from us. Thank you very much. Assalamualaikum.